Welcome to Ask the Expert, an award-winning daily series from 8:30 till 9 to help small businesses. If you have any questions, ask them in the comments of the live feed. If you need any more advice, join the official Intuit's QuickBooks SMB community group on Facebook. Accountants and business experts are on hand 24/7. During the live session, we'll be running a poll, so please do engage with it and I'll reveal the results at the end. Hi, I'm Lucy Johnson. I'm a fully qualified accountant and the owner of Isle Bookkeep, a newly established bookkeeping and accounting firm based on the Isle of Wight. I have over 6 years experience working in both practice and in industry. At Isle Bookkeep, we specialise in implementing paperless systems for our clients, with a mission to take the stress out of accounting and to help business owners feel more in control of their finances. So today we're going to be doing accounting terminology, and we're going to basically hit all the basics today. So let's start off and dive straight in. So assets, these are things that you own. So things like your physical property, money, vehicles, things like that. We have both fixed and current assets. So fixed assets are fixed. They are land, buildings, machinery, vehicles. So as you think, machinery is not particularly fixed, but it's a lot more long-term kind of thing. These can also be called long-term investments, and they can be turned into cash without affecting the day-to-day running of the business. They can also be known as non-current assets because they're not current, which will go into current assets now. So current assets are things such as cash, accounts receivable, inventory, and these can be turned really quickly into cash. They can be liquidated. They're called current because they can be liquidated. So for instance, your accounts receivable, you just need to chase somebody to receive your payment. But we're going to go into that a little bit more in a minute. Intangible assets as well. So we have both tangible and intangible. But what do these mean? So tangible assets are the things that can be touched. So this is a lot of things. So I'm going to talk about what intangible assets are to help you. So intangible assets are things that can't physically be touched, so intangible, right? So these are the things like your copyrights, patents, trademarks, and licenses. So for instance, I have a license, that is an intangible asset. Right, we've done assets, let's go on to liabilities. So these are things that you owe. So these are your debts or your obligations that the business has, right? So we have fixed and current ones. So the fixed ones are obligations that are over a year, due in more than a year, right? So these are things like your mortgage, okay, your loans, long-term liabilities. So they're also known as long-term liabilities or non-current liabilities. Let's go on to current liabilities now. So these are amounts that are due within 1 year. You think about it, current, it's within the year, okay? So these are the same type of things like loans, but they're shorter term loans, and things like your taxes. You know, your taxes will be due within the next few months kind of thing. It never normally goes over a year. Now we're going to touch on accounts payable and accounts receivable because people get these confused all the time. So for starters, accounts payable, this is your creditors. This is the amount owed to suppliers for your goods and services, okay? Accounts receivable, on the other hand, are your debtors. The amount due after the sale or service has been completed, right? So these are the people that owe us the money, okay? So accounts payable, we owe them, we owe our suppliers. Accounts receivable is the money that we are owed. We need to receive that money and we need to pay it in the other sense. We also hear a lot the word aged debtors and aged creditors quite a lot. So I thought I'd explain what aged means. This basically means that we have outstanding terms for both or for either, right? So it means that we either have an overdue amount into us or out from us. Okay, so if it's our debtors, it means that we have that outstanding amount sat on our accounts receivable. And if it's aged creditors, the same with our payable. So we need to pay our suppliers. The terms are overdue. Now here, terms are, say we had credit terms with a supplier for 30 days. This is where the terms come in. It could be 30 days, 60 days, it could be whatever you want. If we go over those, that's when we have an aged, that's when we go into the aged part. Next point, this one is one that people fall on actually quite a lot. It's the word income. So you might hear income, revenue, sales, turnover. There's so many. Basically, this is money that is received into the business for commercial activities. So selling of goods and services, right? Some of these words can also include dividends and interest. So be really careful with what one you're using, but the majority of the time, people are talking about your sales of your goods or your services, or both. The turnover is pretty much the same, but it's the amount that the business has made over a period. So most of the time, you'll hear somebody say, what was your turnover last year? And they're meaning last year's turnover, you know, the income throughout last year. Right, now we've done income, so let's go on to expenditure. So expenditure is also known as, I'm sure you know, purchases. So this is anything that's purchased for a business, right? Or for your business, should I say. So this could be payment of salaries, anything literally that you can purchase, right? I'm sure you get that. But now I want to touch on deferred, because this is something that people say, what's deferred? I have no idea. You have both deferred income and deferred expenditure. So deferred income is income that's received or recorded before it's earned. So in my case, we might bill for somebody's next year's self-assessment. We split it across the months to help them pay it a bit easier. We receive it now ready for next year's payment. So this is deferred income for me because you're paying for a service that we have not yet completed. So we haven't actually earned what you're paying for, basically. Deferred expenditure. So expenses that aren't relevant or included in the present accounting period are declared deferred expenditure as non-current assets. Okay, so they're transferred to the profit and loss account when they actually become current assets. Stay with me, okay? Now, another one that's quite a big one, accruals. I know it sounds really scary, but I'm going to start off actually with the easier one, prepayments, right? Prepayments, it's sort of what it says on the tin. You've prepaid something, right? So an amount is paid for in advance, such as insurance, rent, anything like that, normally for the forthcoming year, right? If you pay insurance, you normally pay for the whole year. But it's very unlikely that it's going to hit your financial year. So you're probably going to prepay. So they normally last for a certain period, a fixed date. Let's now go on to accruals. So accruals is pretty much the opposite of that. So the expenses have been incurred but not paid, right? So for things like salaries or interest payable on a loan, estimates of these items should be included in your profit and loss account and then adjusted when you actually receive the invoice, okay? So you think about it, electricity. So your electric bill has not yet come in, right? And we expect it to come in next month and it's going to be £100. We think it's going to be £100 based on, you know, how we've been spending our electric. We think it's going to be £100. To cover this month before going into the next month, which is a different financial year, right? We would need to accrue for £100. If then the bill came in a month later, we've received it and it includes part of that month, and it turns out that month was actually £150. We could then make an adjustment for that £50. but at least we've accrued for 100. So we're not miles off. So hopefully that gives you a little bit of an explanation. I'm going to give you an example here of a word, arrears. People say, what is arrears? What is arrears? So if your rent is 3 months late, that's considered 3 months in arrears. Okay? Okay, cool. So the last 2 points I'm going to leave you on, these are really good ones to kind of get your head around. So we have both cash accounting and accruals accounting. So cash accounting is only paid invoices are accounted for. Okay, so when you've actually spent the cash, that's when we count it. When you've actually received the cash, that's when we count it. Okay, not I've sent them an invoice, but they haven't paid yet. Right, I'm going to go on to that. So accruals accounting, this is accounting for invoices in the period that they're received. Okay, rather than the period they're paid. So you send out an invoice for March, then you send out an invoice for March, it's received in March. You've received it, it's got a date of March on it, it's the invoice date, okay? With cash accounting, if you don't pay that until April, it goes in April. With accruals accounting, it does not matter when you pay it. You could pay at the end of April, doesn't matter, you can pay it anywhere. You still need to count it in your accruals accounting because of the dates. So this has been a real whistle-stop tour, and I've got so much more on this topic. So I'm sure I will be catching you all up with a lot more details. But I hope this has been really informative for you. You can always reach out to me with any questions that you've got. I'll give you all my links at the end of the show. But now I'm going to go on to answer some of your lovely questions. Right. Get that out of the way. So, Carol on Instagram DM, what's the key difference between the accrual basis and the cash basis? And how do you decide which is right for your business? Really good question. So I'm sure you've probably just heard I've gone through accruals and cash. So what's the key difference? Well, the key difference is when you're accounting for it. How do you decide which is right for your business? Good question. So basically, I would suggest that cash accounting is used for small businesses and your accruals accounting is used for bigger businesses. In some aspects, do check. Some businesses will have to do it through accruals accounting. So yeah, see what's best with your system. A lot of the time, best practice is accruals accounting. If you're very small, you can get away with cash accounting. But yeah, it sort of depends how your business works as well. If you've got a lot of if you're paying invoices a lot later, you might be more inclined to go through like a cash accounting kind of thing. Right, let's have a look at the next one. Oh, this is a big one. Let's have a look. I understand what an expense is, but within that, I get confused with the different types of expenses. What the different types of expenses are, such as fixed, variable, accrued, operational. Then within those, there are categories. Some things are discretionary or unavoidable. What do I need to know? This is a massive question. So this is from Shoaib on Facebook Messenger. Apologies for my pronunciation. So you're asking basically about costs that make up kind of different parts of your inventory, right? So we've got fixed costs, we've got variable costs. So I'm going to start off by explaining different parts of your expenses. So fixed costs, these aren't going to change. It's your rent, right? It doesn't matter. Let's go with chairs, right? It doesn't matter how many chairs you sell in your business, manufacture, right? You're always going to have to pay that rent, okay? When we go to variable costs, okay, if I make 10 chairs, I'm going to need so much wood. If I make 20 chairs, I'm going to need double the amount of wood. That is a variable cost, right? Accrued, well, we've just gone through that. Hopefully you understand that a little bit more. Basically, it's just accounting for the costs where they fall. And remember, you're only going to use those principles if you're using accruals accounting. and operational. So these are your day-to-day operations expenses. Okay, so your costs of goods sold, right? Okay, let's have a look at some other questions. Okay, this is a bit of a different one. So Kira on Twitter DM. I've always been confused by dividends and therefore just kept paying myself a salary. Would it be better to do dividends instead? Okay, so I'm assuming you're a limited company and so you're taking a salary, that's great. Would it be better to do dividends instead? Well, there's a few benefits. So first of all, you've got £2,000 worth of tax-free dividend allowance. So you should be making the most of that. As well, it sort of depends on how much of your salary you're using. It will be better personally if you were on a lower rate tax band, so like a basic rate tax band, you would be paying quite a bit for your salary. You'd be paying 20% over the personal allowance, right? I'm getting technical here. Stay with me. Whereas with dividends, instead of 20%, if you're on your basic rate, it's only 7.5%. So you can see there's a huge difference there. Also, I would be asking you about national insurance. So with your salary, you'll be paying your national insurance on it if it's above a certain threshold, which is also why I need to sort of know how much. So what I always would advise is to use your threshold, your £2,000 on your dividends. Anything above that, you're then going to be paying 7.5%. Great. And then pay yourself a small level director's salary. If this works for you, you know, it sort of depends on the amount that you want to pay yourself, right? But then just hit the lower earnings limit, and this is going to allow you to contribute to your, you know, your national insurance contributions to your state pension, basically, but also not pay national insurance. So there's a lot of things that you can do that are going to be really tax efficient, but it completely depends. Yeah, you want to do it that's going to work for you and your circumstances, that's going to be most tax efficient. Feel free to reach out if you need any help, or you just want to kind of go through your circumstances. I'm quite happy to go through that. Let's have a look at the next one. Oh, okay. So George on Instagram DM. What is a credit score? How does it work when it comes to businesses? Okay, I'm not really going to go into the depths of this because it's not actually my area. I do know about a credit score. So basically, this is basically how well you can pay back things, right? So it's really good to have a good credit rating so that you can get credit, with your suppliers, which is what we were talking about with accounts payable earlier. And yeah, it's just really, really important to have a good credit score. You can get things like mortgages. So yeah, it's quite an important thing. And basically, you need to build that trust and show that you can pay things back quite quickly. But again, I'm not an expert with this. So yeah, you're going to need to reach out to somebody who's better at that than me. But hopefully that gives you a little oversight and it makes a little bit more sense. Oh, this is interesting. Okay, so Sahara on Facebook Messenger. As my business is service-based and primarily operates digitally, and I work from home, I often get confused what falls into the category of assets and capital for my business, and then why it matters. Okay, so I am actually going through this in another talk, so I'm not going to go into too much detail, but your assets are your big items. You've just bought a £2,000 laptop. That is your assets, right? So this is what we're talking about with that. Capital, if you've put money into the business, you've started the business and you've put a few grand in, that's your capital into your business. If you're getting confused with what goes in what category, feel free to reach out and I can kind of direct you in what way works. The next thing I'm actually going to pick up on about that is you're saying you are service-based, you work from home, exactly the same as me, to be quite honest. So make sure that you're having an allowance in there for your working from home. And yeah, make sure that you're accounting for everything. Like if you're working from home digitally, you need to be accounting for all the software you use, the computer stuff, like everything needs to be accounted for. So yeah, and then why it matters. Well, it matters basically because everything's accounted for very, very differently. So an asset and expense are going to be completely different. They're completely different codes. They're treated completely differently. So do reach out, let me know, and I'll go through that for your circumstances. That's no problem. Right, Frankie on Twitter DM, can you explain to me what equity is? Why does it matter? Is it something I should keep track of? Okay, so your equity is the amount that you have into the business, okay? So why does it matter? Is it something I should keep track of? Yeah, it is basically. Anything like this, you need to be keeping track of to have the best understanding overview of your business. If you're, I would just advise that you have a really good overview of everything. So for me, I have like my accounts set up. I look at them every month. Like I have certain things in place, and yeah, I would definitely say to keep track of that. If you need any help, just reach out and I'll have a look into that for you. Okay, this is touching on something actually that I'm going to be talking about in the future, but basically, so Joyce on Instagram DM, I understand in theory what a depreciating asset is, but I don't quite understand how we factor this into our bookkeeping. What if we over or underestimate how much that asset is worth over time? Okay, so basically, for anyone that doesn't know, depreciation, well, what is it? It's basically the amount that the asset is losing, right? As you know, the best example I always think of is a car. As soon as you drive it off the forecourt, how much is it depreciated by? It depreciates so quickly. I don't really want to touch on this too much because I'm kind of talking about it in another one, but basically we've then got appreciation, which is pretty much the opposite. It's what, the properties normally do. They normally go up in value, right? So I just wanted to explain that so you understood. So you don't quite understand how you factor this into bookkeeping. So basically you need to have an allowance every year of how much you're depreciating it by. You need to have rules basically set out, so your standard policies of how you depreciate items. There's so many different methods. Have a look into things like the straight line method, diminishing balance, things like that. See what works best for you, choose one, factor it into your policies, and that's the best advice I can give. How do you do it with bookkeeping? Well, with bookkeeping, you're gonna take off that amount every year and basically accumulate it. If there are any differences, because I've seen you said about an over or underestimate and what happens, just make an adjustment. So that's no problem at all. You can always see if there's kind of any issues. Like if you then find out, you get kind of a valuation or a fair value of that item or that asset, then you can always make amendments. So that's no problem at all. And there's different things like fair value of the product, market value, things like that. So have a look, work out how much it is, and then depreciate it based on that. The best way as well is to do, how long am I going to have this asset? Is my car only going to last 5 years? If it's only going to last 5 years, depreciate it over 5 years. How much do you expect it to then be sold for? Things like that. But I will go into more detail in another video, I promise. So let's go on to the next one. Phil on Facebook Messenger. What do you do about money? Our business, what do you do about money? Our business owes externally, but we're paying off over several years. Technically, it's a debt, but I don't want it showing up in our bookkeeping each year, putting us in the red. Okay, so yeah, it is a debt. So this will be a liability, as we explained before. So yeah, it's one of those things, you're just going to have to pay it off every year. And it's just going to be an amount that reduces your liabilities. Your liability will reduce, okay, as you pay it off. It's just going to be one of those items that is going to be sat on your balance sheet, which I know I haven't gone through today. But basically, this is your statement of financial position where your assets and your liabilities lie. But if you need any help, you know where I am. Okay, Alana from Twitter DMs has asked, how can I set up automatic pension submissions? So basically, we have like a payroll software, and we have to kind of opt into different systems. And basically, with pensions, you can automatically opt in, and yeah, your accountant will do it for you, basically. If you're doing it yourself, it's just a system that you need to work through, set up the pensions. So yeah, you also need to make a decision which pension provider you want to go with. So it's a case of just researching into that a little bit more. But once you've decided, there's like a clear step-by-step to go through the accounting or payroll software. And yes, I'm training to be accountant. Oh, sorry, I forgot to say. Maxine on Instagram DM. So I'm training to be an accountant, but later on in life, thinking about moving to the US. If I do, are there any terminology differences that I should be aware of? Okay, yes, but also no. There are some that are really similar, but like anything, US and UK are quite different. They do have different ways of saying things. And yeah, there are things that are completely different. So the majority, I'd like to say that the basics are the same, and people will know what you mean in the accounting world, but you can tell the difference between speaking to a US accountant and a UK accountant. So that's all for today, I think. Yeah. So the poll results are in. Shall we go through it? You ready? So we asked you, do you find accounting terminology confusing? 30% of you said yes. Wow, that's actually quite a large percent. 50% of you said no, which is brilliant. Half of you are feeling good, so that's really good. And 20% said sometimes. So it is pretty much a 50-50 split. So if you need anything, I'm always here. So that leaves it to me. Thank you for tuning in this morning. If you want to contact me, feel free to DM me on Instagram. My thing is @Islebookkeep. And find out more information on my business at www.islebook-keep.co.uk. Coming up on Ask the Expert on Monday is Dr. Cameron Shake, founder and managing partner of Morgan Breach Accountants. Tune in for the latest business news, strategy advice, and accounting tips. A reminder that if you need any more advice, join the official Intuit's QuickBooks SMB community group on Facebook. Accountants and business experts are on hand 24/7. I've really enjoyed answering your questions today, and have a great day. Bye.